Okay, we are live. This is episode 5 of the business of e-commerce. And today we're going to talk about the financial side or the funding side of growing a D2C e-com brand. And today I have Eric Youngstrom. Eric and I have known each other for a very long time. He has a lot of experience in the SMB e-commerce retail space. He was at Shipping Easy before, Stamps.com, and now he focuses on the funding side of e-commerce business e-commerce businesses. So to kick off the show, Eric, I think when we were talking last time, you told me this great story of like two entrepreneurs that we both personally know, and when they launched their business, it was all with credit. They had like 4 different Amex cards, and they were just maximizing it, and that's how they really funded their business, right? So let's just start with that story.
Sure. Yeah. So, these two guys built a fulfillment shop, and incredibly successful. They actually have enjoyed a really successful exit. And what they did was use their Amex cards to really manage working capital for the first couple of years of their business. But it was not without a lot of pain and headache because you're constantly trying to pay down, make sure there's open balance, things like that, so you can just kind of keep up with the business. And it's really kind of that story and watching merchants using Shipping Easy, using Stamps.com, right, who are struggling just to keep up with the known good orders coming into the system when their credit cards were maxed, their postage balance was empty, and yet here's this good order, and they couldn't afford they didn't have the $7 in cash on hand to get that next, Priority Mail Express shipping label.
Yeah.
Probably dating myself. I don't think those things cost $7 anymore. But the premise is that all businesses have a working capital challenge, and in the e-commerce world, right, that's really an inventory, advertising, and shipping and fulfillment set of expenses. And we built Onramp to really go help these e-commerce small business owners solve that problem, right, where they have their credit card, and we're kind of the next step in that financial journey.
Yeah, so I think for most people, when they start, maybe they're just starting with a Shopify store. I think it's perfectly fine because your first focus is like launching a store and getting the product and making sure that you can even drive some traffic. And I guess it's fine to just start with the credit cards. But when you start growing, pretty soon, I think the problems you'll run into, like we were talking about, is let's say you have to buy up inventory, and typically I think in e-commerce the cycle is it takes around like 52 days or so on average to sell that inventory, right? And then
That's
maybe
right.
there's lead time for you to get it. So if you're talking about like 50 to 90 or 100 days, that cash is locked up in that credit card, and then you're not getting that money back, right? And as you scale, pretty soon you're going to hit your credit limit, you're going to pay interest on that credit cards. So you really hit this bottleneck of like you don't know how to finance your business, and I know, and then I've been through some of this. It's not easy to go to a traditional bank, right? So let's just talk about when you go to a traditional bank, and they're going to ask you for all kinds of stuff like P&Ls. I mean, you like, what are the typical things the bank is going to ask you for, and is that a good thing for like someone who just launched a Shopify store?
Right. So if you're just launching, right, like you're running that business on your personal capital, and that personal capital, includes, your savings and then the credit you have available. Most people, when they launch an LLC, right, they'll get a bunch of mailers and they might get a, $1,000 card offer for that LLC. It's still going to be personally attached to your personal credit profile and your personal borrowing capabilities. And so if you try to go into a bank, they're gonna want to go look at the things a traditional bank looks at. Banks provide financing to consumers and businesses, and for businesses, they support mechanics and donut shops, restaurants, and e-commerce. But because of that, they need all businesses to conform to one approach, which is, I want to look at your income statement, your balance sheet, your cash flow statement. In an early stage business, this doesn't have those. More importantly, the bank wants those to be audited so that they can rely upon them. When you're in an early stage of that business, you can't afford to go spend money on an audit, right? Or you may not even have a year's worth of statements, which means that first year you're not eligible to be audited. And so you just can't go work with a bank because they don't know how to say yes to you yet. So really, Onramp is designed to help SMBs before they've kind of graduated to a state where they've become mature enough, they've been running long enough, and they can afford to go take those steps in terms of getting audits and whatnot, and then go submit that documentation to a bank. And so I read one stat a while back. The average bank line requires about 400 pieces of paper. It touches 26 different people in the bank, and it takes about 90 days to go from beginning to end.
Yeah, and I guess they have to do that because, like you said, right, they are not, they are giving loans to all types of businesses. It could be like a repair shop, it could be like e-commerce. Whereas if you could really focus on, and then I want to get into this, like I think what really intrigued me when I first started, when I spoke to you, and then I kind of started researching into the space, is that the kind of data you can make a lot of credit worthiness decisions. You don't need P&L and balance sheet, right? You can just look at, go to the source of data. So let's just talk about that. So you guys, like OnRamp, for example, you plug in directly into the Shopify store, and then you're extracting the data, or to the Amazon 3P account, right? Let's just talk through like what kind of information do you look at, and how do you make those decisions on how much you can lend to a particular business?
Right. We try to make it really easy, right? So just like, a merchant's going to sign up for Ordoro, right? And they're going to connect their Amazon and their Shopify stores so that the order flow is coming in so that they can go generate the shipping labels to ship those orders. We're pulling that same order data in because that actually is the order information that's creating your revenue stream, right? And so we're getting that same real-time order feed. We're using that then to go calculate the revenue you're generating. We're actually, pulling historic data in as well, because what you've done historically is a good indicator of where you're going, over the next, 3 to 6 months. And then we're making sure that you have the capital on hand to have to purchase the inventory that's going to sell over that period of time. And, you talked about this earlier, right? You purchase inventory. Typically it's kind of 2 to 4 weeks before inventory gets from your supplier to you. And then you're going to break that down so you can go sell each individual unit. And then the average inventory turnover cycle for an e-commerce business runs about 50 to 60 days. And so, what OnRamp does then is uses that data stream, looks at those timelines, and then is trying to optimize that working capital loan so that the inventory you're purchasing, the advertising necessary to turn that inventory over, and the shipping and fulfillment costs you're going to experience to translate each discrete order into that final shipment that gets to that buyer's home so you can capture that revenue, that you have the cash on hand to do all of those things. And what that's doing then is allowing a merchant to free up their personal funds out of the inventory asset, so that they can then decide, hey, I want to go spend additional money on advertising, see if I can sell this inventory faster. Well, if that's happening, you're going to need more cash for more inventory sooner. And then OnRamp's aligned with that, right? And so the whole purpose is we're that working capital line that is very, very tightly aligned with the working capital needs of your business. And because we're monitoring the sales performance in real time, then we know as your business is growing that you're going to need more capital. We can calculate how much that is. Then we can go provide that additional capital to your business so that you can keep up with the demand that you're proving you can capture, and you can keep then testing more ways to generate more demand. And you'll know that the capital's there to support you as that demand is coming in.
So you don't need, you don't look for the traditional P&Ls and balance sheets and audited financials and all of that. You're just going straight to the store and maybe even connecting to the bank account to kind of watch the balances changing. So, okay. And I assume since you guys are very much focused, you only do e-com, right? You're not doing any of the other. Okay. Yeah. So you can fine tune your mechanism for exactly what patterns to look for. So you're very focused and very specialized tools, but achieve the same result, same answer of how creditworthy is a business using that analysis instead of the traditional documents.
That's right. So we're going to look at some traditional things, right? We've got your order data, right? But we're going to connect to your bank account. We're going to look at that bank data. That order data really allows us to start building a big portion of the P&L of the business, right? Because you can see the sales. The bank data is letting us see, okay, what did you spend on that, that batch of inventory with that supplier? We can then kind of go calculate, hey, great, we're beginning to get cost of goods sold in there. And then we're using that to really determine that line before you've even been able to go build, an audited set of financials, right? But because the data about the merchant is coming from these trusted third-party sources, Amazon, Shopify, Bank of America, we're then able to take that and build a decisioning engine that doesn't rely on these traditional forms of underwriting. Now, we're going to pull a business credit report from Experian about that business because we're looking to see if there's other issues we should be aware of. But most of these businesses, that report is pretty thin because they've only been around for a little while.
Right. Yeah.
And so it's really the sales performance and it's the bank account and, do you miss payments, right? If you have other kind of financial challenges that are really then driving the decision around how we operate with that merchant. We recognize we're dealing with a business segment that's traditionally viewed as high risk, your early stage businesses. But we built a product that really helps us de-risk that and empower merchants with a set of capital tools that really that haven't been available prior to this.
Okay. So since you're pulling data from, I assume that you need to be, the source needs to be very trustworthy, right? So are you limited to certain platforms? I assume, I know you talked about Shopify, Amazon. Are there other platforms also you can pull data from for this?
Yeah. Today we work with Shopify, BigCommerce, WooCommerce, Squarespace, Shopline, Amazon, Walmart, TikTok. And we're looking, we're working on adding additional sales channels, right? We just like it shipping easy and
cover a lot of the big ones. Yeah, I think you and I can relate to a lot of that, right? For me, for Ordoro, data needs to come in, so I need to be connected to those sources. So it looks like pretty much the same list. And then on the decision side, since I guess this is all very algorithmic, so does it mean quick turnarounds, I assume, right?
Our fastest customers have come through, signed up, and within an hour have had funding going to them.
That's awesome.
Typically, on average, we're doing it in a day or two. But most of that time is actually the merchant talking to one of our sales representatives or account managers. They want to understand what's going to happen, right? Money's a very emotional topic. And, you are borrowing. And so, I think it's wise that people are picking up the phone and saying, hey, just walk me through how this is going to work. So they can really understand it, that they can get their questions answered. And they can start using the product. And really after their first advance, it becomes really simple, right? Because now they've become comfortable with it and they've seen how it aligns with their sales and their inventory turnover in a way that's really empowering them to then take, the personal funds they would have had captured in that have been released, right? And they can then go think about, do I want to try a second product? Do I want to go open another sales channel? Maybe I want to do a little bit bigger inventory purchase so I can get to that first discount break for volume. And then we're aligned with them in that.
Okay. So since you are also looking at the order history, I assume that you need to see some history before before someone can use a service like Onramp, right? So I assume that means when I'm launching a Shopify store, still credit card is my option for day one, right? I need to build up a little bit of history and then go to a service. And so I kind of want to understand the band that a service like Onramp would fit into, right? Is there a certain GMV threshold, like a monthly or annual that you're looking at? And is there a point at which maybe now they're eligible for a traditional bank and they should outgrow your service and go to a traditional bank? Can you just talk about that?
Sure. Yeah. On the kind of entry side, our bare minimum is $3,000 in monthly revenue, right? So you kind of have to have enough cash on hand in your personal savings and your credit cards to get.
Do you look at the age of the business? Do they need to have run that business for a year or so, or it's just
we've
on launch? Yeah.
We've worked with customers who've literally, been operating for less than 60 days and they've been able to get that first 3,000 in sales.
Awesome.
We typically like customers who are about 20K in revenue, but we have programs designed to work with the very early stage guys. And then, really the graduation event, right? Graduation being what we think of when a merchant has become big enough and sustainable enough that they're qualified to work with a bank. That typically happens somewhere between kind of $5 and $20 million in annual revenue. And the reason for that is, most of these e-commerce business owners are not starting these businesses with a finance background. They don't personally have a finance background. And so because of that, they're not focused on how do I go finance the business. They're focused on, I want to make my product better. I want to fix my supply chain. I want to get better at my operations. I need to get my marketing going, right? My merchandising, my pricing. There's a million and one things you have to do when you're a small business owner, and finance is but one of them. So somewhere between that $5 and $20 million revenue range, that business starts to hire, kind of a VP of finance, CFO type person. And that person arrives and they're going to start cleaning up the books, right? And that takes 3 to 6 months. They're going to then make sure that they can go get those books audited. And that takes another 2 to 3 months. And, probably $15,000 to $25,000 in audit expenses. That person, by the way, costs, $150,000 to $250,000 a year in salary. And so if you think about a $5 billion revenue business, then let's assume that they're doing a 15% net margin, right? That's $750,000 in net that goes to the owner. But if they're going to go hire this person and do this work, well, you just took $200,000 or more of that cash to the owner out of the business to go give to somebody else, right? And so you kind of have to hit that minimum revenue range before you're going to start saying, hey, I want to go spend that money on a head count. And if you're running a 10% margin, right, you're talking about almost half of your take home going to that right? And so that's why we kind of see it reaching that size. And a good example of this is on the operations side from a fulfillment perspective. If you're running, if you're doing your own shipping, when you've only got 50 shipments a day, you and your high school age kids can kind of keep up with the volume, right? At 250 shipments a day, you're actually hiring employees. Right. And all of a sudden you start to think about who's going to manage that. When you hire that person who's got experience running a warehouse, they come in and they organize that warehouse, right? They say, hey, the highest volume product sits closest to the shipping line and the slowest products the furthest away, so that we're minimizing steps, right? Well, you think about that person brings that sophistication in. The same thing happens on the finance side. As you get bigger and bigger, you're bringing people in who understand that, who can go make you more sophisticated.
Exactly. Yeah. I think for most people, like, I can imagine, like, if I just launch a store, I probably don't even have a QuickBooks account, right? I'm just like, just flying by just by looking at bank statements. And even like for me, when I launched, like, starting with QuickBooks was a big deal. And I have a third-party bookkeeper who I need to meet with on a monthly basis to make sure that the books are regularly up to date. And I'm sure like most entrepreneurs are not even bothering with that, because that's like the least fun part of launching a business, the accounting, right? So you don't want to deal with that.
Yeah, no, I mean, look, for the first 6 months of operations of OnRamp, we did the accounting in Excel, and I did it.
Exactly.
I have a finance background. And then we moved to QuickBooks, right? And that was not an easy process, right? Getting all that data from Excel into QuickBooks and kind of getting things cleaned up. And now we've got a really good operating cadence there. And so those are the things you do as a business owner, right? And what we're here to do then is our tools are tightly aligned with your business in terms of how we deploy funds and how we automate the collection of funds that we're owed, in a way that when you do graduate to a bank, it'll be really easy to understand how to use a line of credit. Like, hey, if I draw it all down and don't repay any, if I need more, I don't have more. But if I pay it down, I'm going to reduce my interest expense. And in fact, the less time I use this, the lower my interest cost is. And then, by the way, that means there's more available for me to go capture more demand. And I want to, buy that big batch of inventory, but I want to start paying that line down again so that when I need the third batch of inventory, it's available to me. Well, OnRamp's really trying to teach the merchants in those early stages how those processes work, so that by the time they're ready to do that with a bank, they've actually got that muscle memory already going, right? They've seen.
Yeah, they kind of know how they understand the mechanics behind it. Yeah, that's very interesting. So it looks like I don't need. So by using a service like this, I'm also learning the financial discipline, right? What is exactly going on? And even if I'm not an accountant, I don't have to look at QuickBooks and I don't have to look at P&Ls. I can just basically look at what's happening within the interactions between my business and your system. I can learn. I guess I can figure out a lot. I had another question around this, right? So when you decide the amount, I guess banks would give you a working capital line of credit for like a year or so. And
Right.
then I will in e-commerce we often hit the seasonality problem, right? Come October, November, I need to buy up a lot more inventory. So how do you guys look at the seasonality patterns and adjust the amounts? Like how does that work?
Absolutely. So if you're like 80% of e-commerce sellers, Christmas is your big season, right? Traditional
Yeah,
retail, Black Friday, Cyber Monday stuff.
yeah.
Um, and so, come August, September, we're looking at your trailing revenue, but we also know that you're going to get a 30 to 100% lift in sales, that you're going to need the inventory to keep up with those sales. And so we're providing more capital for that. As you sell through, right, and it's getting into December and you're starting to say, hey, look, I'm going to run out of inventory by Christmas, right? I'm going to have enough to kind of get me into early January, but I need to get that Q1 batch of inventory in. Well, the seasonal indexing is going to tell us you don't need as much as you needed for Christmas. So let's bring that, let's give you what you need. But if we give you more capital than you need, you've got to figure out how to pay that back with fewer sales in that slower Q1 period of time. And so we are optimizing around the seasonality of the business. The other interesting
Which
thing
is what, like to your earlier point, that's what like a CFO, or even if I have a fractional CFO, that's what they would do, right? They're going to tell
right,
you, here's your capital needs. Whereas you guys, just based on seasonality, your system is able to like tell the merchant, here's how much money you need, right? Based
correct,
on your sales. That's
yeah,
amazing.
and
Yeah.
then and look, if you're selling garden supplies, well, Christmas isn't your big time of year.
Yeah.
Kind of March and April are, and so then our data lets us go see that, right? And we see that not just for the one seller who might have a year and a half of history, but we can go look at all the garden supply guys and kind of say, hey, look, as a segment, here's what we think you're going to need based on your data and the broader e-commerce portfolio that we service, right? So that we can be really, as helpful as we can to help make sure that the demand that's coming is going to be captured. And then as stuff slows down again, the other important thing when I think about financing is the cost of financing is really driven by two factors: the amount you borrow and the time it's going to be outstanding. And so from a working capital perspective, what you want to do is borrow just enough to keep the next cycle turned, and then pay that down as quickly as you can so that cash is available for the cycle that's going to follow. And so we're on-demand capital. We're always ready for that next batch.
Yeah.
But what we're trying to do is minimize the cost to the merchant so that we're not giving more than they need, and we're not giving it to them for longer than they need, because we're going to be here when the next batch is necessary.
Yeah, that's awesome. I think that discipline part is something that I really like, because like I see this all the time, right? Most people who launch their business, when they start seeing this growth, they don't really understand the mechanics of financing side. So I think using something like this also teaches them that discipline by you guys are calculating the amount and the terms and all of that. Do you do you do you require like personal guarantees to get a line of credit?
No, we don't do a personal guarantee. We do have a what's called a bad boy acts guarantee. So if certain malicious things happen, but the goal is the business should stand on its own 2 feet, right? Like, look, this is my 5th startup, right, at OnRamp. I like building these businesses. I have a huge affinity for the small business owner. It's an incredibly hard thing to build a business, and the quicker that business stands on its own 2 feet, the faster it's going to reach sustainability. And the mission at OnRamp is we want to see as many of these small business owners become sustainable, where that business is what lets them, pays for their house and lets them save money for college for their kids and things like that. Some small business owners are going to say, hey, $2 million a year with a 20% profit margin is more than sustainable, right? Even a 10% margin, I'm paying myself $200,000 a year. Somebody else is going to say, no. My ambition is I want $100 million a year. Well, great. Well, for that $100 million a year guy, as he's making his way to that, we're a tool for a time, right? When he's going from kind of 0 to 10 million. For that business that is, look, I'm always going to be a $2 million, $3 million a year revenue stream, and I don't care to get bigger. I have other priorities in my life. Well, then we might be a tool for them forever. It's not my job to tell somebody what their mission in life is and what they should accomplish. It's my job to help them, accomplish what is important to them.
Cool. Awesome. I think we have kind of run out of time. So this was like super informative. And I really like a lot of aspects of this, right? I think you guys are very focused on e-commerce, so you know exactly the patterns that you're looking for. That's awesome. The automation part that I don't need to gather up audited financials and everything. That's awesome. And then the whole financial discipline part. I think that's very interesting. Eric, thanks a lot for your time. And I know that we had to do like this. We had to do the show in like two parts because of technical difficulties last time. It
No
was
problem.
fun talking. Yeah, it was fun talking to you. And before we go, just a plug for Ordoro. So Ordoro is a shipping order and inventory management solution for e-commerce. So if you're a DTC, direct to consumer e-commerce seller selling through Shopify or Amazon as a third-party seller, take a look at us. We can help you with your shipping label printing, managing orders, and inventory management, and all of that. That's all I have time for today. So yeah, stay tuned. Take a look at, keep watching my LinkedIn feed for the next talk that's coming up next week. Thank you.
Thank you.